So you can have the most
Okay, here we are.
sophisticated models out there, the fastest data feeds, a perfectly crafted portfolio. But what happens when things go south? When the market turns against you? Well, it turns out your biggest asset, or, your biggest liability, isn't actually in your portfolio. It's in your head. So, in this explainer, we're going to dive into exactly how to make sure it's an asset. Oh man, we've all been there, right? That just gut wrenching feeling when you see red flashing across your screen. Your heart starts to pound, and all that super rational, careful analysis you did, phew, it just flies right out the window. This quote just nails that feeling, that exact moment when emotion tries to wrestle control away from logic. And that really brings us to the core question here. It's not inflation. It's not a market crash. It's not some geopolitical mess. No, the biggest risk, it's something way, way closer to home. We're going to answer this by the end, I promise. But first, we really need to understand the battlefield, which is our own mind. Okay, so let's kick things off with our first cognitive bias. It's this mental trap that basically keeps us chained to information that's completely irrelevant. It's called anchoring, and it's what happens when we get totally stuck on a number that has absolutely no bearing on the future. So, what is this thing exactly? Well, anchoring is just our human tendency to lean way too heavily on the very first piece of information we get. And when it comes to investing, guess what that is? It's almost always a price. That price becomes our reference point, our anchor, right? And from that moment on, we judge everything else against that first number, even when it makes zero logical sense. All right, take a look at these classic symptoms. I mean, how many of us are guilty of this? Fixating on a stock's purchase price. You've definitely heard someone say it. Maybe you've even said it yourself. Oh, I'll sell it as soon as it gets back to what I paid for it. That right there is textbook anchoring. You're literally chained to a historical number, even if the company's entire story has changed. Here's the hard truth. The market could not care less what you paid for a stock. It only cares about what that thing is worth right now. Okay, so the big question is, how do we break free from this? We have to force ourselves to recalibrate. The fix is to just consciously, deliberately ignore that old price. Instead of looking back, you've got to look forward. Ask yourself this one simple question. Knowing what I know today, and based on its future prospects, would I buy this stock right now at its current price? If that answer is no, well then your anchor is dragging you and your portfolio straight to the bottom. All right, let's move on to our second bias. And this one is especially sneaky because it often hits the smartest, most successful people the hardest. I'm talking about the silent killer of capital, overconfidence. So, put simply, this is the bias where we trick ourselves into believing our own predictions are way more accurate than they actually are. And what does that lead to? Well, we end up taking on way too much risk, trading all the time, which just racks up fees, by the way. And we make these huge, concentrated bets because we're absolutely convinced we found the one. So, do any of these ring a bell? Like, you see a terrible earnings report for that stock you love, and you just brush it off as, it's just short term noise. Or maybe you double down on a losing position, completely convinced that you're right and the entire market is wrong. Look, that's not conviction. That's overconfidence, and it's a blindfold that keeps you from seeing the real risks. So, what's the antidote here? It's a big, healthy dose of humility, backed up by cold, hard data. Don't just tell yourself you're a great stock picker, prove it. Seriously, track your predictions, keep a decision journal, go back and review your success rate. Let the data tell you how good you actually are. That's how you swap out that blind belief for real evidence based conviction. Okay, and that brings us to our third bias. And honestly, this might be the most powerful emotional hurdle of them all. This one is wired deep, deep into our evolutionary brain. It's all about that gut punch of pain we feel whenever we lose something. We're talking about loss aversion. It's that powerful force that makes a dip in your portfolio feel like an actual physical punch to the gut. This isn't just some academic theory. It's a deeply felt emotion that can totally derail even the most well thought out investment strategy. Research from the legends themselves, Daniel Kahneman and Amos Tversky, they found a really startling number. They found that the pain of losing something is psychologically about twice as powerful as the pleasure of gaining that exact same amount. Just let that sink in for a second. $1,000 loss hurts twice as much as $1,000 gain feels good. And that right there explains so much about why we make such crazy, irrational decisions just to avoid feeling that pain. Yeah, because we hate that feeling of loss so much, we do things that make absolutely no financial sense. We'll cling to a losing stock, just hoping and praying it'll come back, because selling it would mean we have to lock in the loss. We'd have to make that pain official. And on the flip side, we'll rush to sell a winning stock, just to lock in the gain, because we're terrified that little bit of pleasure is going to vanish. It's the perfect recipe for failure. You end up cutting your flowers and watering your weeds. So, how do you beat an emotion this powerful? The only way is with a pre planned, unemotional system. You have to take your future panicked emotional self completely out of the equation. Before you ever click buy, you need to decide what your pain tolerance is. Is it a 10% dip? Is it 20%? Whatever it is, you set a hard stop loss limit. And then you have to promise yourself you'll stick to it, no matter how you feel when that moment comes. Let your rules guide your decisions, not your regrets. Okay, so we've diagnosed the three big problems, right? Anchoring, overconfidence, and loss aversion. Now let's put it all together. We need an actionable battle plan. It is time to build a solid mental moat around your portfolio. Here it is, your four-step checklist to build that mental moat. Step one, to beat anchoring, you have to train yourself to ignore what you paid for something. Focus only on its value today. Step two, to fight overconfidence, you got to get brutally honest with yourself. Keep that decision journal. Review your track record. The numbers don't lie. Step three, to handle that powerful pull of loss aversion, automate your exits. Use those preset limits we talked about. And finally, step four, this is the ultimate check on all your biases. You have to actively look for reasons you might be wrong. Go find the most scathing bearish report on your favorite stock and actually read it. And really, this is the whole ballgame. Look, in today's world, information is basically free. Everybody has access to the same news, the same data, the same fancy charts. So your real competitive advantage, your edge, it's not about finding better information anymore. It's all about having better behavior. It all just boils down to that ancient wisdom, just updated for the modern market. Your brain will lie to you. It's going to inflate your confidence, it's going to exaggerate your fears. You can't just wish these biases away, but by understanding them, you can build a process to check yourself before the market checks you. And that brings us all the way back to the question we started with. What's the most dangerous risk in your portfolio? It's not a stock, it's not a bond, it's not the economy. It's the person staring back at you in the mirror. Master your mind, and you'll finally be on the path to mastering the market.
Okay, so this is a short video about how we should deal with behavior bias. That everyone has his own bias in terms of behavior, and we need to be prepared for that. Let's look a little bit deeper into this and look at the main problems that I mean, there are more problems than these, but these are the most typical problems that we face when dealing with the market. And so let me just try to tackle each one of them individually with maybe a few examples from my own personal experience, which are better. Okay, consider looking at angry. Angry means that we are fixated in some kind of price. Can be a price when we started, can be a price that the market reached at some time. And we tend to be fixated into a specific price, especially in the relation to the stocks that outperformed quite a lot, or those that underperformed also substantially. We usually tend to anchor in relation to extreme positions, and sometimes we also anchor because the price is a round number. Let's say, for instance, one of the best stock picks that I made, which increased quite a lot, was, I think, as far as I can remember, it was the best. And somehow that stock reached the price close to 2000. And the stock and then what happened is that I was very satisfied with the stock. It has been going up and down. I was also averaging up, so I started buying more of that stock. Was happy, but then sudden just before reaching the 2000, the stock started to decline, and it declined I think 5% and then 10% and so on. But I was so fixated in the 2000 the 2000 dollar that I couldn't move from that number, and I even added a few more stocks to the position, which wasn't really very wise to do. Probably I should take some profit, or at least sell part of the stock and the profit something else. But it's a problem also with doing that, is that we have to incur a cost, tax cost, and so we try to avoid that. But again, you see, one gets paralyzed by having this ideal price target in our mind, and we forget about what we can do. Of course, in our platform, we have a few tools that we can use to address that problem. For instance, I'm fixated, for instance, in this 2000 price. The first thing I must do is go and check what is the price target for that stock. If my price target to that stock is not above 2000, then I should change my mind, even if I'm really in love with that stock and I think it will reach the 2000 level too soon. So it happens to everybody. It doesn't mean doesn't matter only for beginners. Even very well-seasoned investors sometimes get fixated into a stock. Is that something that we have to bear in mind? And if you think that you are anchored to a given price level, you better check, do a bit of due diligence on that stock and see if that is really reasonable for you to do that. The other thing that happens sometimes is a question of overconfidence. Overconfidence is not too bad. For instance, if you have a stock that suddenly starts going down, but you believe in the stock, then you sort of close your eyes and close your ears to anything that says that the stock is still going down. It will probably go even lower than that. Just to remember also one story of my life. A few years ago, I had a very a very large position in Apple. In fact, too large, and I was not managing my own money. I was managing somebody else's money, and I decided to manage his account with a 30% position into Apple. And Apple suddenly started declining and declined quite a lot. And in those days, the stock was losing almost, I think, 30%, something like that. Fortunately, my investor was a seasoned investor, so he didn't get too worried about the fact that the portfolio was going down. And I kept telling him that I expect the company has to recover because it's a solid company for this and that will recover sooner or later. And in fact, I was lucky enough that the stock really started recovered and then not just to recover the 30% loss, but it started increasing substantially. Maybe because, I don't know, Warren Buffett started buying Apple or something like this. I don't remember exactly the details. But the important thing is that this overconfidence sometimes may turn against you. And in my case, because I realized that I had been stupid to have such a large position in a single stock, what I did was to make another mistake. What was the mistake I did? Okay, so the stock is now on a rising trend. It's rising quite well, but I was so upset by having lost the stock having declined by 30% that when the stock reached the previous price, I decide to sell half of it and then just keep half of it. So, and the stock then continued rising much higher above the market. Again, because I was, I had been overconfident, and then I decided to repair my mistake, and by making another mistake. So in a way, overconfidence can work in both ways against our best judgment. And again, how you can avoid that? It's by looking at data and by doing a due diligence and trying to assess better. Do not rely on our instinct, on our, beliefs that we can be quite strong. So that's the problem with overconfidence, and another problem is the problem of again, loss aversion. So if you are very worried about losses, then it can also work very strongly against you. So that if you get upset when you start losing 10%, for instance, and when you then suddenly are losing 20%, and then you get even more upset. So when your pain limit is really taking over your behavior, then what happens is that sometimes you make stupid decisions. That's why we have tools to allow people to estimate what is the when a loss is compatible with what happened historically, or when a loss is really out of any past experience, and then we can calibrate our emotions around that the type of loss aversion. So we have a volatility charts in our platform. We'll show you some that can be and should be used to do that. But of course, this is more serious when people take very large losses and then get stuck without wondering whether they will be able to recover from those losses or not. And to avoid that, so we'll talk about that later on in more detail, but a simple way of avoiding that is to have a very stringent rule that tells you to sell any stock that loses more than a certain amount, and no matter what you end up deciding to close your position if you have but again, loss aversion and anchoring and being enamored with a certain stock is always something that messes with your own judgment. Well, let me give also, since we are an example, dealing with my own prejudices in this matter. I also had a very funny experience with Netflix. I had made quite a good killing with Netflix, but then on a recent position that I took, it started losing quite a lot, and I have all these alerts telling me that I should sell. I should have already sold the Netflix, and but somehow I'm resisting that, and I'm still holding the position because one gets sort of emotionally attached to a given stock, and then drops his own rules that he should have acted sooner than later, and that's I'm still holding that position. Also, I should have sold it a long time ago, or some time ago, not a long time ago, but some time ago. So Again, this is a serious problem that we need to address. It's part of the mistakes that we do as well. So the important thing is to avoid those mistakes. And speaking of that, then we should remember this fourth problem, which is the question of how you manage our fear and our greed. So our fear that the stock still continues to go down, and our greed that we expect stock to continue rising, going up to the moon. Here we have again different situations. For instance, a typical situation that arises that you realize too late that the stock has gone quite out of the chart, so to speak, and you think that you missed an opportunity. It happened with me, for instance, in relation to NVIDIA. So I missed the story of NVIDIA, and so the stock went sky high, and still sky high. And what was the decision? I didn't want to recognize that I had missed the story, the NVIDIA story, and then I decided to take a different position, which was, instead of accepting my mistake, out of fear that the stock will reverse, I decided to pick a stock that was very correlated with NVIDIA, and it hadn't appreciated that much. So let's say it was a runner-up in terms of the race in relation to NVIDIA, and I decided to invest in that stock. And it turned out that it was a very good investment. But also, when I look at it right now, I realized that, in fact, if I had invested in NVIDIA, it would probably even be better. So the fear I had that the NVIDIA story was already close to the end led me to investing into a similar stock and an alternative stock, but it turned out that the front runner actually ended up running faster than the second runner. So you see, and very often we make these decisions on the base of we fear that the stock is going to reverse soon, or we take them in terms of our greed, or we don't know how to manage these two symptoms. And we always face, and it's probably one of the most important things that we need to consider when investing, is how we can manage this fear and greed sentiments that we have. Now, the other thing that we need to consider is whether we analyze too much. I mentioned that already. So we faced with fear or greed, we decide to analyze, we run the risk of analyzing too much. And then if we analyze too much, then we get paralyzed. We don't decide, or when we decide is already late. So we took us too much to make up our mind. If it takes us too much to make up our mind, then when we're going to decide, it's already too late. We missed already the train, or at least we missed the fast train. We'd have to take one of the slower trains, So it's something that we also need to be careful about. And of course, we need to use our toolkits, the toolkits we have in our platform. I'll just remember a couple of them. And they should be somewhere here. Okay, let me see if I can go. Okay, we have already, this planning tool, but we also have under this planner section, the profile tools. If you need to to show your profile, you can record your profile, or the profile that you imagine your client, if you are working for a client. Of course, you can use the profile for your client, so that's important to run your profile, and then check it from time to time as well, because we can record here running the tests we have here for some time, and then we should check them from time to time. Now, the other tools we have, especially in analysis, to check whether it is reasonable or not, is to, well, actually, let's look at to see how is Netflix now. Is to look at this. So you see Netflix have this running down. Is we can look at some of these ratings we have, like the sentiment rating here, how it is. It has improved recently. You see, if I did the opposite, which was I want just to keep the SMC here. So it's the past few days it has improved quite a lot, the sentiment in relation to the to this rating, but we can also look here at what is a reasonable drawdown of this company, and if you look at here, the company has experienced in the past quite a number of drawdowns, like this one here of 14%, a loss of 40%, or 10% is more frequent even. 5% or 6% is quite common. So you see the company has a lot of negative 20-day, this is a 20-day price changes, a lot of quite a lot of negative, so they are quite frequently. The positive runs are not so frequent, with the exception of, but they are much higher. You see, this it's a 10% frequency here, and the run was a 24% positive. So overall, the company, if I look at this, I say they can move fast and quite a lot. I mean, like for instance, here was really 100%. So it's really quite a big run of the company. But if you compare with this one, okay, I see that I have to wait longer to have a good positive run, to recover the previous loss, because I know that the company quite frequently has this pattern. Of course, I probably need to change here the dates. I would like to probably need to go and look at some other dates. I would have to change them upstairs, not upstairs, above. I would need to change the dates here. I would have to change these dates here and look at the back if I want. But to say, this is one of the very good tools that we have that allow us to assess what we should do. Another interesting tool is looking at the price target. You see, we had this is the first one doesn't count because was before the stock split, but since the stock split was done, so we started with a price target of 140, has been now reduced to 136, but they are still price targets above the current price, which is 93. So there is room for the company to improve. And if you look at the beta is also quite high, but the 3-year and the 5-year beta. So which means that the market increases, the company will recover fast. But of course, I should also take into account that if the market collapse or starts lagging, then the impact of the company may be quite significant as well. So the company will not recover as fast as that. So this is the kind of tools that we can use to better judge what we should do, and we should really take a look. And of course, we can run look at the financials. Are they improving? Let's look at sales. Sales are improving. There's a problem with evaluation. Evaluation was slightly is quite low now, but it was quite extremely high before. So, but so far things are not bad in terms of return. Still very good return company with sales still improving. So from a long-term perspective, I can also look at the financials and see if it is worthwhile keeping the position or closing the position. Okay, so these are some of the tools that we have in our platform that you should use to address the problems caused by behavioral bias to optimism or to pessimism that we will have. And that's something we can't avoid.